Welcome to Supernatural Stocks on Moneyweb with your host, the Finance Ghost. This is your weekly fix of equity analysis designed for stock pickers. Whether local or international, you can expect a mix of news and my ideas about what I'm seeing in the markets. Regular listeners to this podcast will be well aware that I am a fan of the new approach being taken at Prosus. I've given CEO Fabrizio Bluisi a lot of love on this podcast, and the Prosus share price has given me a lot of love in return this year. At the Capital Markets Day in London this week, which I managed to catch a fair bit of from the comfort of my chair here in Cape Town, the management team took their story to the global market. The tech vibes were clear, with the group's CFO electing a smart collared shirt and pretty much everyone else dressed down in the style that has become a characteristic of the modern world of tech CEOs and platform businesses. And why not? That is what Prosus is at the end of the day. And by the way, I'm just going to refer to Prosus here instead of Naspers because Prosus is their global brand and that's the one they seem to be focusing on and pushing. Instead of digging too much into Bluisi's presentation or talking about the AI demonstrations put forward by other execs, I'm going to touch on an area that was ignored by the market a few years ago when central banks were pumping zillions into the economy. Yes, I'm going to focus on the financial section. So from golf shirts to collared shirts we go, with some key takeouts from CFO Nico Moret's presentation. The PR people have certainly done their work here. Prosus is full of memorable concepts in its presentation, like millions to billions and not just value, velocity. Growth stocks are all about storytelling to the market, and they know what they are doing at Prosus when it comes to this. The reference of millions to billions is a nod to the profitability in the business. We might be used to seeing references to billions in the size of deals at Prosus and even trillions when it comes to their market cap in Rand, but the e-commerce profits have been a story of millions, and only in the past couple of years, millions in the green. They want e-commerce adjusted EBIT to grow by 4 times from FY25 to FY28. As with most of the numbers that they put forward in the deck, this ambition assumes that the Just Eat Takeaway.com deal in Europe will close successfully. I covered this in a previous episode of Supernatural Stocks this year. But how will they get there? And what are the broader strategic focus areas from a financial perspective? Let's dig into the priorities for the CFO of Prosus. Priority number 1 is enabling profitable growth. My, how things have changed. Not just growth, but profitable growth. Now, there's plenty of forecasting risk here, obviously, but it is interesting to note that Europe is the region that they expect to be their jointly fastest growing area over the next 3 years. From FY25 to FY28, they think that European revenue can grow by 2.5 times. They have a similar growth expectation of 2.5 times for Latin America, albeit off a much smaller base than Europe. And in India, this is really interesting, they only expect 1.3 times growth over that period. This shows you how mature the Indian app and services ecosystem actually is, which is why the Indian market has so spectacularly outperformed the manufacturing-focused economy of China in recent times. It's a pretty interesting read-through for investors in the Indian market, a market that is trading at a premium valuation. I would be careful there. Now for a regional look at adjusted EBITDA expectations. Latin America shines through here as the best margin expansion opportunity. Based on growing revenue by 2.5x, they expect adjusted EBITDA to be 3.5x higher by FY28. In Europe, of 2.5 times revenue growth, they expect 3 times adjusted EBITDA. And in India, which isn't actually generating a profit yet, they hope to reach a 5% margin by FY28. And this does make India a significant drag on group margins. Again, one has to wonder how overcooked the Indian market is right now and whether investors are actually ignoring other growth regions at their peril. As a final comment on profitability, the presentation indicates that the adjusted EBITDA margin in the e-commerce business is still lagging peers by a substantial 700 basis points. That's 7 percentage points. Now, this would be a very big problem if Prosus was a mature company, because a gap like that would be really difficult to close. But when you understand the margin expansion that is inherent in platforms that are scaling, then it is quite likely that they can actually close this gap. This is an example of the infamous hockey stick shape in which losses first get pretty bad before the profits suddenly come through the door in a big way. It's typical of technology and platform businesses, as they need to put a lot of fixed infrastructure in place before the real money comes in. But once that starts happening, The relatively low variable cost component means that most of it drops to the bottom line, and the bottom line is where the shareholders are, waiting for their profits. Of course, the bearish counter-argument here would be that the peer group is also scaling, so the current peer group profitability is a moving target. Importantly, where the peer group margin has expanded by 6 percentage points from FY22 to FY25, Prosus improved by 15 percentage points from losses into profitability, and this is something that the market will watch closely going forward. I must also note that Prosus adjusts for stock-based compensation here, in line with what the peer group does. Now, this will always be a bugbear for me in the market, with technology companies doing a lovely job of pretending that paying bonuses with shares is somehow not an expense for shareholders. For comparability purposes, though, it is correct that Prosus calculates their adjusted numbers in line with how the peers do it. And here's the main thing I think you should remember. Prosus is finally in a place where the business, excluding Tencent, is generating positive free cash flow. As Bloezy points out in his presentation on the day, they've moved from being a Tencent minus business to a Tencent plus business. Annual free cash flow in the ex-Tencent business has increased by $1 billion since FY22. That's a big improvement. Priority number 2 for the CFO is optimizing the balance sheet and capital structure. Net of the Just Eat Takeaway.com deal, Prosus will be sitting on net debt of around $3.9 billion on a pro forma basis. With the ex-Tencent business no longer eating up cash, this means that the balance sheet is in strong shape overall. The maturity profile of the debt goes all the way out to 2052, with very little in the way of near-term maturities to worry about. Now this leads us to priority number 3, which is active management of the Prosus portfolio. Now that is very different to saying deployment of capital. Active management talks to decisions to invest, sure, but also decisions to pull back, or even dispose of things that are not working. They have a slide in the deck that says, we have discipline and will make trade-offs. A lovely nod to the fact that capital is a limited resource. I know this sounds incredibly obvious, or at least that it should be obvious, but this is just so different to the zero-cost money environment we found ourselves in a few years ago, when the previous management team deployed tons of capital at the top of the cycle with reckless abandon. As evidence of the trade-offs, they've unlocked $2.6 billion in disposals in the past 12 months. Admittedly, they've deployed $7.8 billion just in large M&A in the past 12 months, including the planned amount for Just Eat Takeaway, but you would expect to see Prosus in a net investment position rather than purely recycling capital at this point. Speaking of investment, they will keep investing in their own shares in the form of share buybacks. This is because priority number 4 and priority number 5 actually sound quite similar to me, with the former being about getting the valuation they deserve and the latter being about reducing the discount in the share price. They are essentially saying that for as long as they aren't trading at fair value, they will happily continue to see share buybacks as an attractive use of capital alongside the opportunities like investing in their existing portfolio and doing new deals. I do wonder about the dividend though. Given the opportunity for buybacks and deployment of capital, you really have to ask if doubling the dividend is the right call here. I think it comes down to signaling around capital discipline above all else and ensuring that Prosus can attract large investors who might include a dividend as one of their requirements. Dividend theory is a very interesting component of the world of finance and investing. Now, as I think I've made quite clear, and just to be clear again, I am long Prosus. In a perfect world and with the benefit of hindsight, one would probably want to invest at the exact moment that the market gave up hope in the hockey stick actually playing out. That's when you get the best risk-reward ratio. But second prize would be to invest during that upward momentum in growth, before it starts to taper off. I would argue that we are now at that point in the journey, with a strong enough growth ambition that I think shareholders should do very well even if Prosus doesn't achieve its lofty targets. They just need to get close. And the Capital Markets Day certainly didn't give me anything to feel concerned about here. If anything, I continue to really enjoy the new narrative coming out of this group. There's no such thing as an opportunity without risk, and these are merely my opinions on the stocks covered herein. Make sure that you do your own research, form your own views on the market when doing anything in your portfolio. Nothing in supernatural stocks should be taken as advice.